All right, let's just get right into it. If you've ever tried trading, you've probably hit that wall and asked, why is this so damn hard? Well, it turns out, for most people, the game is kind of rigged from the start. But here's the thing, it's not about bad luck. It's about something predictable, something hardwired right inside our own skulls. Just look at this number. This isn't a guess. This is from massive research, looking at millions of trading accounts. And what did they find? A staggering, almost unbelievable truth. Somewhere between 89 and 94% of regular retail traders lose money consistently. I mean, that's not just a rounding error, that's a flat-out epidemic. We have to figure out why.
So that's the big question, right? Why is this failure so predictable? I mean, think about it. If trading was just a coin flip, you'd expect the numbers to be around 50-50, but they're not even close. And that tells you something huge. This isn't about random chance. There's a pattern here, and it's rooted deep in how our brains are wired to make decisions, especially under pressure.
And let's be clear, this has nothing to do with how smart you are. It's a neurological thing. The reason so many people fail has a name, and it's a cognitive trap that pretty much everyone stumbles into if they don't have a solid system. It's called hope-based trading. So what in the world is hope-based trading? Well, it's pretty much what it sounds like. It's any decision you make based on pure emotion. You know that gut feeling, that voice that says, oh, this stock just has to turn around. Or that wishful thinking that your losing trade will magically pop back into the green. Yeah, that's it. It's the total opposite of a systematic, analytical approach that's built on cold, hard data. And get this isn't just some abstract theory. You can actually see it happen on brain scans. fMRI studies show something absolutely incredible. When a trader makes a systematic, data-driven decision, the logical, rational part of the brain, your prefrontal cortex, is humming along, highly active. But the moment a hope-based trade happens, that same rational center just switches off. I'm not kidding, its activity drops below its normal resting state. And at the same time, the brain's reward center just explodes, lighting up by over 200%. Your brain isn't making a logical choice anymore. It's literally just chasing a high.
Okay, so what this brain science really does is lay out two completely different paths for every trader. Path 1 is guided by random emotional impulses, chasing that high. Path 2 is guided by a clear, repeatable strategy. And believe me, where these two paths end up couldn't be more different.
Let's break it down. On one side, you've got the hope-based trader. They have no defined risk, they're totally ignoring the bigger economic picture, and they're often doing the worst thing possible, averaging down on losers, just hoping they'll come back. But on the other side, you have the data-driven trader. They operate with predefined rules for everything: entry, exit, position sizing, risk. It is literally the difference between chaos and order.
All right, so how do you actually make that jump from chaos to order? Well, the research points to a really powerful, really practical solution. And it's all about understanding a key correlation with the US dollar index. You might have heard of it as the DXY. This is a perfect real-world example of what a systematic approach looks like in action. Now, for anyone who's not familiar, don't worry, it's pretty simple. The DXY is just a weighted average that measures the strength of the US dollar against a handful of other major world currencies. You can basically think of it as the official scoreboard for the dollar. And here's the secret sauce, the reason this matters so much. Just look at the breakdown. The euro, it makes up over half of the entire index, almost 58%. This isn't just a random mix of currencies. It's a very specific mathematical structure. And that structure creates an incredibly powerful and highly predictable relationship. So because the euro is such a gigantic piece of the DXY tie, it creates this super strong, super reliable inverse correlation. What does that mean? When the dollar index goes up, signaling a stronger dollar, the EUR-USD currency pair almost always goes down. They're like two ends of a seesaw. One goes up, the other has to go down. It's almost a mathematical certainty. And when I say reliable, I mean really reliable. Look, a perfect, flawless, inverse correlation would be -1. And for the last 20 years, the correlation between the DXY and the euro dollar has been rock solid, hovering right around -0.9. That is one of the most consistent, predictable relationships you will find in all of finance, period.
Okay, so once you understand that powerful relationship, the proof of why it's so important just becomes overwhelming. Let's look at the hard numbers, what multiple different data sets show us about using this one single piece of information.
This first data set, it's based on an analysis of 43 million trades. And the results are, well, they're stunning. Traders who were systematic, who are aware of this correlation, had a 43% survival rate after 4 years. Now, what about the hope-based traders, the ones who ignored it? A measly 2%. That is the survival difference of more than 20 to 1. Think about that. One simple check changes literally everything.
And it's not a fluke. This pattern holds up across different studies. Here's another data set. Fully systematic, automated, rule-based accounts had a 67% survival rate over 5 years. And the hope-driven, discretionary accounts, just 3%. The conclusion is it's undeniable. Having a system is the absolute key to longevity in this game.
But this next one, this is where it gets crazy specific. This table zeroes in on the direct impact of using the DXY. Traders who made it a rule to check the DXY before every single trade, they averaged a positive 21.4% return per year. And the traders who never checked it, they averaged a negative 24.3% return. That's insane.
Just let that sink in for a second. The performance gap, the difference between someone who does this one simple, systematic check and someone who doesn't, is 45.7 percentage points every single year. This isn't just a small edge. This is the entire ballgame. So the evidence couldn't be clearer. The data basically presents us with a choice, a fork in the road. So let's turn all this information into a clear, actionable strategy. Let's talk about how to move away from just hoping and start moving toward a real strategy. You know, the path forward here is actually surprisingly straightforward. Step 1 is just admitting that the hope problem is real. Step 2, build what we can call correlation literacy. Start by learning the DXY inside and out. Then, from there, you develop your own systematic rules for when to get in a trade. And finally, the most important part, you implement rigorous, unbreakable risk management. It's not magic, it's just a protocol for being a professional.
When you boil it all down, this isn't about being a genius or having some special talent or even getting lucky. It comes down to a really simple choice. Are you going to accept the empirical, data-driven reality of what actually works? Or are you going to deny it and just keep on hoping?
Because really, it all comes down to this final thought. After all the research analyzing mountains of market data and millions of trading accounts, the verdict is in, and it's absolute. Hope isn't just a bad strategy. In the world of trading, hope is a mathematical guarantee of failure. So the only real question left is, which path are you going to choose?